Hey, Realtor family, Brendan McKay here to talk to you about assumable mortgages. Very, very popular topic. What assumable mortgages means is that when somebody's selling their house, they also just hand off their mortgage to the buyer, right? Very popular concept right now because interest rates, as they sit right now at the time of recording, are significantly higher than they were 6 months ago and for the 2 years prior to that. So wouldn't it be great if the buyer could just take over the seller's mortgage, right? And take it along with the house. And on FHA and VA loans, you can. On conventional loans, you cannot. So what I want to talk to you about today is some of the features just like that, how the process kind of works, and what some of the problems are that you should be aware of before you go too far down the hole. Okay, so I'm going to quickly explain some of the guidance on FHA assumable mortgages. Everything I'm going to say on FHA is also true on VA. VA has a couple extra things that we're going to go over. First, primary residences only. The buyer cannot be buying it as an investment property or a second home. All right. And if you're going to go through the process of assuming a mortgage, your favorite loan officer is not going to be involved in the transaction. Okay. You're going to work directly with the lender that is currently servicing the loan since it's their asset, right? So you go to them, say, hey, we're selling this house and I'm working with the buyer who wants to assume the mortgage. What's the process? And also, what are your turn times, right? So you kind of know how long it's going to take to close this transaction. Now let's look at some VA specific stuff. This is just talking about going directly to the seller. Don't worry about automatic authority. Any lender large enough to service a VA loan has automatic authority. Now, on VA, there's something, VA mortgage is something called entitlement. Every veteran has an amount of entitlement. It's a number used to calculate their eligibility for VA mortgages, okay? And it's important to note that if a veteran seller sells the house to another veteran, the entitlement that's tied up on that VA loan transfers over with it, okay? But if they're selling it to a non-veteran citizen like myself, it does not, right? It sits on the seller's entitlement. And here's why that could be important. If they're selling this house and they're planning on using VA financing for the next house, it might have an impact on their ability to do so. It might mean that they have to put a small or a large amount of money down on that next one. They might not have to put any down at all. It depends on some factors. But make sure that they know that going into it. Any loan officer that does a significant amount of VA business can do this calculation. It's called a dual entitlement calculation, so that they know. Even if they plan on buying in cash or using conventional financing, God forbid, on their next purchase, I highly recommend that you just have this calculation done so that they know just in case, okay? This is just talking about they're going to go through underwriting. The servicer's basically going to underwrite them for creditworthiness. They have 30 days to respond. FHA has 45 days. That doesn't mean you can close it that quickly. Also, there's a funding fee. Unless the buyer is a disabled veteran, there's 0.5% funding fee of the loan amount that's tacked on, okay, to all the other closing costs. They cannot finance it like the funding fee is normally financed. This one has to be paid out of pocket, but it's much lower at 0.5%, all right? That covers kind of the bells and whistles of the process. What I want to talk to you about is assumable mortgages is talked about a lot more than it's executed. And the reason why is that there's the loan amount, right, on the mortgage, and then there's the sales price, and you got to figure out some way to bridge the gap. And unless they just bought the home, a lot of sellers out there have a ton of equity right now, right? So let's say it's a $500,000 home with a $400,000 mortgage. The buyer is going to have to show up with that $100,000, okay? It can't. There's not a lot of options out for it. Back in the day, there used to be something called wraparound mortgages. I haven't found one yet. I've been looking everywhere. They don't exist in the market right now, to my knowledge. And it's a bank or lender, more likely a bank or a credit union, willing to do a second mortgage that will sit in second lien position on an assumed mortgage, okay? Those don't exist as far as I know right now. The seller can do what's called a seller held second, but not every seller is going to be in the position to do so. They'll probably, especially on VA and FHA, when you probably put 0% down when they bought the house or 3.5% on FHA, a lot of those buyers don't have $100,000, $200,000 to float the buyer, okay? So the buyer is going to have to show up with cash. So it's really only eligible for buyers with down payments to work with, or more likely to be. So that's kind of the hitch on all this. But if you find the right situation, it's certainly something to market and get more attention to it. And if you find the right situation, it can be a big deal for a buyer with a down payment or a house without a ton of equity. So that's it. If you have any questions about assumable mortgages or anything else mortgage related, feel free to shoot me an email or reach out in the comments. Take care. Bye.